Hey there, in manner of introduction, I'm Francis Hunt, the market sniper, the crypto sniper, the founder of Hunt Volatility Funnel Method, and I've got a really exciting session for you. In fact, we're going to touch on the macro. We're going to be taking a look at the debt markets, but where I'm going to end up taking you is to Bitcoin. The conclusions I'm going to be giving you is that it's a great accumulation. We're at halftime. We're all eating our oranges, and that there's a great, and even better, I would argue, second leg and bull market to still come. And we'll talk about where we might end up with that. But first of all, just to sketch some of the macro elements, it's quite important to talk about other markets outside of crypto. I think this is the wind in the sails of the overall market. So without further ado, we're going to go straight into the bonds markets. We're going to be looking at the treasury note yields. Why are we doing this? Well, this is a real pivotal macro market. As many people that are talking about the fiat failure. In fact, we have a debt bubble before we have any other bubbles. Gold, silver, Bitcoin, anything else, we have a debt bubble. And we're going to take a look at the yields. Now, as I was saying, when I was wearing much younger clothes, we were running into the Paul Faulkner fighting of inflation that came out of the 70s, Nixon taking the dollar off the gold standard, running right into the beginning of the 80s when interest rates were super high to control inflation. You might see a little bit of a head and shoulders there if you have the eye for a bit of macro technical analysis. And that's what we're going to be doing today, talking about the great macros. What I'm highlighting is a 40-year cycle that has actually transpired. So here we have the 10-year treasury yield. You can see it's pretty well annotated now. And I'm showing you in the pink box the head and shoulders that coincided with the Paul Faulkner years of taming inflation that came out of the 70s of Richard Nixon removing the dollar off the gold standard, running into the late 70s, into the 80s with ever escalating interest rates. Since that head and shoulders, we have been in a cyclical downturn in trends. Most of you will recognize that the Greenspan era came in and around 1987, regular liquidity experiments. Each of these little orange dots that I'm highlighting were regular points where once again yield collapsed. You had continuation patterns on a macro basis, ongoing over the decades. And once the course was set with Alan Greenspan, pretty much all Fed chairs were committed to a similar course. The key reason this is really interesting, and I want to make a major macro technical point, is that often the big trends die with a final melt up if they're bullish or a final capitulation if they are bearish. In this term, this particular instance, we're talking about the yield, which is dropping. And I've also log scaled this chart. So in terms of actual rates here, this is a log scale. You can see that the log scale chart highlights what a supreme capitulation in relative percentage terms this final events of March 2020 were with the pandemic. In other words, trends end with macro capitulations. It's my assertion that the subsequent policy changes that have come about as a result of the response to the pandemic of March 2020 is the end of the bond yields bear curve. That means bond prices down and yields starting to go up. But as you probably heard, the nature of the debt is so high, so much that the rate at which this reinflation of yields and deflation and loss of value in bonds is likely to be very slow. And the Fed is probably likely to be behind on inflation, despite recent narratives that you've just heard. I want to highlight, I am calling their bluff in terms of what they can do. And in short, the opportunity that is right now available to us as investors and traders is the big long on a scale that makes the big short of the subprime seem rather small and piddly. So great. You can see that final capitulation. I have another chart that I wanted to show you that is in the oils markets. I want to highlight this. We were kind of well noted for calling single-digit oil going into 2019. I'm going to reframe that scaling to regular and just cover a similar point just to show the absolute final capitulation and the extremity of volatility that occurs at trend change events. So for most of my childhood, oil was in the 10 to 35 range. You can see the 80s, 90s trundling along. As we got into the financialization of everything era, you could see that the oil tax, I call it a global tax, on activity, then spiked with the great subprime. So as we were all making so much extra money in our property portfolios and our landlording and everything that went with it, the easy credit and the low money and the great gift of globalization, that market was going up. That was a super bull market also for oil. They were skimming us with their energy tax. Yes, indeed. And subsequently, we've had deflationary crisis after deflationary crisis. So these are these events that subsequently occurred, as you're very familiar with, the subprime, subsequently the collapse in 2014 into the lows of 2016 in oil. We were involved in that short, and more recently from the stage calling for the first time in multi-decades single-digit oil. The key point here is note that capitulation to an extremity of low. Super high vol going into that event, and a really ridiculous, beyond the sublime to the ridiculous in terms of what ended up happening on the futures market. Now, as typically in traditional technical analysis, and we are macro technicians here, the larger the move to the downside and the more extreme it is, so too the reaction to the upside with regards to technical events here. So our expectation now is, in fact, that energy created with that sell-off to the downside is creating an extremely strong market for oil. A lot of right sizing would have occurred. A lot of offshore drilling would have been curtailed. A lot of shops would have been closed, and the supply chain reduced to meet these new extreme levels of demand, only to find that the green energy is not yet filling this. So where does this take us? Once again, I'm making a case for the big inflationary long. The expectation here in oil is that we'll surpass the double-digit range that we were in at this point over here as part of the break that has occurred on what is a macro-technical, multi-decade falling wedge. The bigger the time frame, guys, this is why I love the macro chart. The bigger the time frame, the bigger the move. The bigger the volatility and the extremity of the action, the greater and the degree and the extremity of the reaction. You want powerful trends. You want the wind in your sails. I'm pointing to you where I think that's going to be. So we've spoken about the debt potential devaluation and the incremental climb on yield. I think they will lag. This will see markets such as oil overperform during this case. By the way, we hit $75 today again. Okay, now this starts to bring me more away from the traditional markets. But before I leave it entirely, I did also prepare a screenshot for you just to cover silver, which is my favorite of the precious metals. And something Raoul and Real Vision, to their credit, does very, very regularly, always looking to measure a market or a chart versus the amount of money that has been proliferated. It's got to get parked somewhere. Many people will say valuations are extremely extended in NASDAQ equity markets, but the problem is the amount of money that's being created that needs to get parked. Here you are. This is silver in 1981. And again, I'll grab my little draw tool. That's 81 up top there. This is one big skater half pipe. We had an incompleted bull market in my frame of reference. There's many reasons why. There's a lengthy discussion to be had to fully address that. And then we once again had silver deflating. You are here in what we call a small little hunt volatility funnel setup, or to a traditional technical analyst, a symmetrical triangle structure in what is a very, very early doors versus M2 potential move. A very early doors potential move. So hopefully throughout this, despite some people saying the inflation trade is being put on ice, our overall macro view is that we have not even yet begun. Those of you that think you're too late, I tell you, this is a trend. You will get out too early. It will keep coming, and it will keep coming, and it could come brutally quickly as things unravel as well. So you could start to see crypto type moves in traditional markets as things unravel. How will the Fed and the rest of the central banking community react to that? I do not know, but it is indeed possible. They will try to control the markets in a manner that there is no disorderly appreciation or depreciation. But once the cat's out of the bag, they have a habit of running away with the game.
Hey, if you like this clip, be sure to like and subscribe for more crypto-related content. Also, be sure to check out the full interview and more only on realvision.com/crypto.